Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The global economic repercussions of the Gaza conflict may not be immediately evident, but they could worsen if the conflict escalates. However, for the time being, it appears that the financial markets in India are relatively unperturbed by what's going on. Additionally, the Indian stock market has demonstrated resilience as it bounced back and finished today's session near its highest point of the day. The developments in Gaza have come at a time when there are key economic issues, including what's happening to US bonds. And joining me to decipher that and decode these developments for us are Ajay Bagga, noted market expert, Geoff, emerging markets commentator, and Anurag Singh, managing partner at Ansid Capital. Thank you very much for joining us. Geoff, I want to come to you for the global perspective first. The tragic killings in Israel and what's happening subsequently, while it's a massive story of human loss and terrorism, but if we go beyond that and try and take a look at where the global economy and especially the US economy stands right now, what would you have to say to our viewers?
Well, first of all, I think you've had the market reaction that you would normally expect. The dollar was firmer. The US bond market was, of course, closed yesterday, but you saw a big drop. You've seen a big drop in yields today, which you would expect as a sort of flight to quality. You've seen at least initially, a flight away from risk, but US equity started to rebound relatively quickly. And of course, the big macro development from all of this is rising oil prices, with about $4 put on the price of both Brent and WTI. I think what that's telling you is that most observers hope and believe that this will be limited to this albeit this very tragic situation. The risk to markets from here, I think, will come from if this is really escalated into an outright conflict with Iran, and I'm not going to comment on that specifically. Against this background, I think the US economy has a very good chance of pulling off the soft landing, if you like, because inflation is probably going to tick a bit lower this week with the September numbers, 3.6 or 3.5. Obviously, the growth of the economy remains reasonable, decent, I think it's fair to say. And I think whatever you think about the inflation numbers short term or the economy short term, I think you should believe that the Fed is nearly finished, may be finished. And I personally believe, although I've been wrong so far, that bond yields are also at or very, very close to their high. So I think the biggest risk to the US economy right now, and I'll leave it here, is a remarkably high surge in oil prices on the back of all this increased these terrible events in Gaza and in Israel. Aside from that, I think things look pretty good in the US.
Things look pretty good. Geoff, one more point before I go to my guests here. How are emerging markets likely to be impacted because of what's going on? And of course, the bond market collapse. And I hear you there, Geoff. You're in the way I understood what you said, you seem to be suggesting that the worst of the collapse may be behind us because you said they are near their highs. But Geoff, what's the emerging market impact likely to be?
Well, there's 2 points to make here. First of all, EM has had another pretty terrible year, frankly, underperforming developed markets by over 1,000 basis points and going down modestly year to date. And that is on the back, in my opinion, of the surprising strength of the US dollar, alongside the big surge in yields. And of course, the big surge in the cost of capital is very hard for the EMs that have a lot of debt. Also, it supports the dollar, as I say, and therefore limits the ability of central banks to reduce interest rates as much as they may like to do at this point in time. And then you've got the overhang, of course, of China, which has had a terrible year. That is going to continue to be an overhang. So we have to watch China separately. I think in the near term, the other point, and I'm sort of repeating myself from my last answer in a way, is that higher oil prices are, of course, a risk to many emerging markets, notably places like India, Turkey, Korea, Taiwan, etc. So that has to be watched very carefully. The best news for EM out of all of this would be sustained drop in bond yields, a peak in Fed interest rates, and the dollar turning around and going down again. And that is something I've been waiting for a while, but frankly hasn't happened yet.
Geoff, one more quick point, because we seem to have you on a bit of a scratchy line, and before it worsens, I just want to ask you about your view specifically on Indian valuations. Do you think there is scope for attractive picks still within the broader Indian space?
I believe so for a international investor, an EM investor. Indian valuations are always a drag, I think, on potential performance, but generally investors are willing to look at the long term and look at the growth prospects, and I think that's still going to be the main driver. And India, I think, will continue to outperform, especially in a world where China is, as I say, struggling, and there's a lot more bad news, I think, to come out of China in terms of, in particular, the property sector. Again, oil prices are a risk. You want to see inflation continue to edge lower in India so that the scope eventually for interest rates to come down. But I think the valuation story is not very different from what it normally is. They're high. There's a lot of domestically driven stocks in the markets. And I think investors don't want those higher valuations for growth that should be very good over the long term. So I'm pretty constructive about Indian equities at this point in time within an emerging market portfolio.
All right, Geoff, Ajay Bagga, coming to you. Indian markets demonstrating resilience. Why is this?
It's a function of domestic flows. So even though we have seen FI outflows for the last 2 months, domestic flows, as they did in 2022, domestic flows are keeping the markets well supported. The second big part would be the macro is good. The policy environment has been very conducive for the companies to grow their revenues and earnings. And the third is that it remains a huge portion of the market remains domestically focused, for example, finance or automobiles or industrials, capital goods, all the sectors that have been doing better, apart from finance, I would say, have been more domestically focused. There's a bit of bother on IT, and I think that will stay for a couple of quarters more till the global macro sees more better growth coming in. But overall, it's the makeup of the market, makeup of the flows, and a strong macro, a good policy environment. It's a function of all that.
Ajay, I'll come back to you on a couple of the points that you made, but Anurag, coming to you, do you think within the mix that we are seeing both globally and within the country, crude oil is perhaps the biggest risk at this point of time? We have heard the RBI's commentary on inflation, and you yourself would have gone into granular detail. So is crude the biggest risk for India at this point of time?
So, Siddharth, I think even RBI in their projections have accounted that if oil stays around in the 90s, I think they've really made their calculations with that assumption. And I think the same is with the global markets. I think markets have accepted the reality overall that crude is not going to, stay in the 70s, which was a pre-COVID times. So it's, I would say it has kind of become a weapon of sorts. I think, Siddharth, we have to look at two things separately, but then in kind of correlation. As the United States has kind of weaponized the dollar, Middle East and OPEC has kind of weaponized the crude oil. Now, these two kind of plays, the markets will have to accommodate and adjust the valuations accordingly. I think as long as it stays in the 90s, it's fine. The crude creates a turbulence in the market if it starts breaching that 100 limit and goes beyond. And I think there are enough forces, even from the United States and otherwise in the NATO alliance that are trying to keep that level below. There is a bit of a supply coming in. There was some supply coming in from Iran. There is a bit of supply coming in from Venezuela that can be opened up. But I think the Western markets are very focused that crude should not breach that 100 limit. That's where we are, Siddharth.
Okay, Ajay, I want to come back to you for the average investor, and many on this show are actually broader market participants, not perhaps very sophisticated or with large portfolios. For them, how should they read the current mix of factors? Because they should, and you would agree with me, look beyond the instant knee-jerk reaction that happens when geopolitical events play out.
Yeah, absolutely. And we have seen that with Ukraine. Ukraine surprised the markets, and it took longer, but eventually the markets moved ahead and they digested the entire Ukraine thing. First time in 75 years in the center of Europe, you had a big shooting war, and which nobody had really expected. And the markets were able to digest that. A Middle East crisis normally is very inflationary. Mr. Dennis was already saying, normally EMs suffer because there is a safe haven buying. So money goes into dollars, goes into yen, goes into Swiss franc, looks for safe havens, gold goes up. So a Middle East crisis is inflationary, and it's negative for emerging markets. That's been the history for the last 50 years. But the good news is for the last about 40 years, it has not had a very staying impact. I think even today, what has happened is based on slightly dovish comments by two Fed speakers on Monday, the US Treasury yields, one would have been the safe haven buying, but also there was a relief rally that came through. So higher for longer rates are not good news because of a stronger dollar. A stronger dollar is negatively correlated to emerging market flows. We have been seeing outflows happening, and today on a debt fund in the US, a non-government, a corporate debt fund, you're making as much as the yield that you get on the US stock market. So clearly the pension funds would favor. You can get a 5% on a money market fund. On a credit fund, you can get anything from 7 to 7.5%. And money will probably go there rather than come into equities. So that flow-wise is hurting emerging markets as well as India. For investors, it's very clear, stick to your goals, look back at your risk appetite, what are you investing for, and just keep investing regularly. And that's what a large portion of the Indian investors, not too many Indians are investors, about 4-5 crores out of 140 crores are the investors, but a large portion of them are investing regularly fixed amounts every month through mutual fund SIPs. And that 15,000 crores, I would bet, has made more money than most of the active managers who have been in and out of the market.
That last line, words of wisdom for viewers to absorb. I know a lot of people miss the excitement of doing direct equity or daily trading, but step by step and sip by sip is perhaps better. Geoff, I'm coming to you. Explain to our viewers what is the latest that's happening in China, because for the last 1 year or so, the red dragon in trouble is a headline that we have seen here, and now there is talk of a potential stimulus given what's happening in the real estate sector particularly. Decode the China situation for us, and what is the likely impact going to be?
Well, there's a lot to unpack here. First of all, as China came out from the zero COVID policy that they had, the recovery of the economy was quick for a short time and then is disappointed subsequently to that. And yet, despite that, the amount of stimulus you've seen from the Chinese authorities, including the central bank, the PBOC, has been relatively limited. You've seen some fiscal action, you've seen a modest rate cut, you've seen some modest reserve requirement cuts, but generally you haven't seen enough action, I think, by the Chinese authorities to really provide a lot of support to growth. And part of the overhang, or perhaps the major overhang that you've got in China, is the property sector, which of course is such a huge portion of the economy relative to the role of property in other economies. And you've seen a number of companies that have either gone bankrupt or have defaulted on their debt or at risk of defaulting on the debt, companies like Country Garden and Evergrande. And frankly, the headlines keep coming through. The country is overbuilt. And I think because of the degree of overbuilding of the country and because of all the fiscal stimulus we've seen in the past, notably of the Olympics in 2008 and the big earthquake in 2008, you have tremendous debt building up in China. And this is what's leading to concerns from the authorities about overstimulating. So getting this economy turned around to favor more consumption and away from exports and away from investment is going to be very difficult. And of course, the final point is that a lot of conversation about China today looking like Japan looked in the late 80s, 90s. And I think there are some significant similarities. So the big question is, when does this get priced into markets? And I think it's not far from being priced into markets, but frankly, I don't expect to see an upside economic surprise out of China for some time to come.
Right. Anurag, where do you see major market risk for the Indian markets coming from? Is it going to be potential concerns around our elections? We already now are in election season with state assemblies in a couple of months from now. And would therefore US be a lesser risk than domestic factors for the Indian market?
Yeah. So, Siddharth, I would put in two directional points here. One is we need to understand the context as to how richly Indian markets are currently valued. We can debate about it, right or wrong, but look at this. France is just about 1.8 trillion market cap, the entire market. UK is just about 2.6. Germany is 1.3. India is 3.3, 3.4 trillion, right? Just about 100% of the GDP. So, I mean, of course, compared to the other markets or other major economies that are a little ahead of us or just thereabout, I think we are, at least twice or more richly valued. And, the multiples are around 25x. We can debate whether if the bond yields are at 7.4% for India, whether the 25x multiple is justified. Part of this also, Ajay spoke about, which is that, if there is a $40 to $50 billion of domestic inflows coming from insurance, mutual funds, other passive investments, and as well as some part of active investments, then, well, who is to, blame? FIs could be just about 10 to 15 billion annually. And, they are kind of just almost bulldozed by the huge deluge of domestic money which is coming in. When the money chases stocks, valuations take a backseat. I would also bring in this perspective, Siddharth, that the Indian market returns gradually on a decadal basis have been reducing. So if you look at the last decade between 11 and 21, the returns were just about 11 to 12% on a Nifty, likely to continue. Now, in an economy which has about 5 to 6% inflation, 11% returns are on a nominal basis looks good, but that's not too great. Risk in terms of, I think other than that, I would say the domestic economy, as long as it keeps chugging along, we need to kind of take a leaf from China's playbook here that, if China sustained for the last 20 years purely on the basis of domestic economy, they didn't bother what the world was doing. and that they gave them a good impetus to a middle income bucket now. Now, India needs to do the same, and I think much would depend on our domestic economy. I completely agree when you say elections and the change of political regime and the return of populism. I think these are some of the big risks. I think some of those discussions that are here in the media, in terms of, the old pension schemes and other populisms coming back, I think that stays one of the risks. And in case the government changes, well, that's a huge one, Siddharth.
Well, yeah, and perhaps it's a little early in the day to discuss that. Ajay, I just got a question for you from one of our viewers, so I'm going to take that. It's actually two questions. I'll try and merge it into one. Is it wise to hold on to cash, book profits in the current uncertainty? And then it's kind of repeated the question, is it time to book profits and shift to other assets like gold? So answer that for the viewer, Ajay.
No, see, asset allocation has to be based on your financial goals, your risk appetite, and the time that you have for each of those goals. So what are you investing for? That should be your main question. It's like you're going to a doctor and you're asking, what is the medicine that's most popular today? Can I get into gold? Because everybody's taking the anti-obesity injection. So should I just buy gold? Just like that? No, that's not the right thing. You have to go back to your symptoms and what are you treating yourself for? So financial planning is very critical right now. Asset allocation, yes, gold has a role in portfolios. 5 to 10% of a portfolio can be in gold, and right now might be a good time. As the rates are peaking, as rate cuts come in, gold will tend to outperform maybe for the next couple of years, you could see. But you can't be 30, 40, 50% in gold because it's a non-yielding asset. So you're looking at safe haven buying and continued buying, a lot of things falling in place for gold to work out. I would say cashing out is a very difficult decision because you don't know when the markets turn, neither on the way down nor on the way up, and the returns are very concentrated. So a couple of weeks or 4 weeks will give you all the returns for 2 years, or say 10, 15 weeks will give you returns for 5 years, and you can't forecast that time. So is this a bad time to be in equities in India? No, the macro is quite strong. And Anurag mentioned there is the political risk which will increase come February, and we are seeing softer markets on the back of that. December 3rd, the 5 state election results will come. So some amount of, if there is any surprise, there could be a little bit. But there is so much money sitting on the sidelines, Siddharth. We are such an underinvested country that, that 15,000 crores of SIPs are going to turn to 30,000, are going to go into 50,000 crore types. So don't fight that trend and invest for that long term. So I would say don't try to time. Nobody can accurately, consistently forecast the markets. I don't even try to do that. I would say stay invested.
Okay. I wonder if we still have Geoff. Geoff, you are still with us, and I want to come back to a point that Anurag made about a certain risk from fiscal populism, political populism in the Indian context. And he said it at a time when the IMF has once again endorsed India's growth potential. In fact, it's bumped up the growth estimate by 20 basis points to 6.3, and this is the latest upgrade amongst a host of others in the recent past. Could the India investment story, the mood around it sour on account of greater populism, fiscal populism that may be brought upon by the state and general elections next year, Geoff?
Yes, that could easily be the case, but I think we have to realize that this is a global trend. And in fact, you could argue that one of the long-term risks to financial markets or risk assets, perhaps I should say over the long term, is in fact that there appears to be a general lack of fiscal discipline in many, many countries. Talk of tax cuts under a Republican administration if the Democrats lose and we get ex-President Trump reelected in the U.S. Talk of tax cuts before the UK election, which is probably going to be late next year. There is there's a lot of fiscal populism around the world, and India is, I don't think, any different from that point of view. India has the great advantage that if the concern is the level of the deficit relative to GDP or the level of debt relative to GDP, that India is growing its GDP very rapidly, much more rapidly than the US or the UK, for example, which I've just mentioned by definition, and now currently more rapidly than China as well, which is also very close to deflation. So there may well be a risk of fiscal populism in India, and I'm not going to spend a lot of time on that. You've got experts on the panel to do that rather than me. But this is a global trend, and I don't see India being any worse situation than other countries, and indeed probably better in terms of risk to financial markets.
Anurag, I want to get you to tell our viewers about the best portfolio strategy looking ahead for whatever time frame is possible, because earlier people would talk about years, but perhaps sometimes many of those estimates don't stand. So what's the best portfolio that investors should aspire for given market conditions and what will likely prevail in the short to medium term?
So Siddharth, it is portfolios are all about expectations, right? And I think I'm with reference to my earlier comment, I think as long as your expectations are tied up to the right metrics, I think that should not be a problem. So equity investors in India should expect 11 to 12% returns on a nominal basis, not more. And that's, I think that's about it. And if you're comfortable with that, those investors will not be disappointed. They don't need to panic at all. The second is, Siddharth, I understand this equity trend has really caught up, but I would really say that, about keep your 30% money logged into fixed income instruments, because, a lot of the investors who are born after 2020, born in the markets, I think they just think that you invest and the money goes up. That's not how it has been working. Third is the global headwinds of, the era of zero interest rates out here in US are over. And I think that's going to have an impact even on the emerging market. So if the US is going to stay at 2 to 3% or 4% rates and not zero, then of course bonds will come to your rescue as well. So I think those are the three broad directional views. Finally, I think, that this is pretty relevant. Stay away from these small caps. They rise 20% in a year and then they fall by 50%, just like that. So I think that's not how it progresses. So that's a word of caution. Finally, maybe if you can take some money off and retire some loans, Siddharth, that's also a good piece of advice as of now. These valuations.
Sound advice considering what's happened to EMIs, for example. Ajay, is the Indian opportunity there for large caps or a mix? Because Anurag spoke about small caps specifically. What would an ideal portfolio strategy be at this point of time?
These small caps, you don't know whether they are being operated or they are actual. So I'm talking from a retail investor's perspective. How many companies can you track? How genuine are those accounts that you are seeing? So better to leave that to the fund managers. So small cap, I would invest through mutual funds, and you have the pick, and where, a fund manager is buying 40, 50 companies. Now you have index funds also, which are giving you access to the entire market for mid cap, small cap. So a lot of options are there instead of trying to pick yourself. The second part would be, is India a large cap story, mid cap story? I would say both. You will get much higher returns, but you will get much more failure as well. In the large cap, it's more steady and the returns are pretty good to meet your financial objectives. So very few will actually meet those multi-bagger types or 100-bagger types. Those are, only in looking back you realize, okay, this was the turning point. or this company made that kind of money. India as a market has made that kind of money because 100 Sensex of 79 had gone up to 10,000 by early 2000. So 2006 or thereabouts. So we have seen 100 bagging on the index itself, but those were different scenarios. You won't get a 10,000 Sensex going to 10 lakhs in a rush. You won't see in one lifetime like we could see. Anybody who started working in the 80s has seen the index itself giving 100 bagging, but it won't happen again. Short answer, mutual funds for small caps don't chase, or even if you have to chase, keep aside 5%, 10% of the portfolio. So if you lose it, as Anurag said, hopefully you will have enough fixed income interest coming through, which takes care of that capital loss on small caps. If something works out, well and good. Rest of it, 70%, I would say, on a general rule of thumb of equity investment in large caps. The smarter guys want to enter mid caps, small caps, and try to shoot out the lights. That's not for 99% of us. I would not
Absolutely.
think.
And the 99%, the big mass market that India is, words of advice from three of the best in the business. Geoff, Ajay, Anurag, thank you very much for your time. And I will just end this by saying that the best way to understand what they have said is, if there's a lot of stuff happening around you, hunker down, batten down the hatches, and don't be greedy. Thanks once again for your time with us today. With that, it's a wrap on this show. We'll be back with more. Until then, goodbye.
And to terrorists everywhere, that the United States stands with Israel. We will not ever fail to have their back.